The stock market can seem like a vast and intimidating ocean, especially for newcomers. But just like any ocean, it's easier to navigate with a map. That's where stock market indices come in. Think of them as signposts that represent the overall performance of a particular group of stocks. Three of the most well-known indices are the Nasdaq Composite, the Dow Jones Industrial Average, and the S&P 500. The Nasdaq is heavily weighted towards technology companies, while the Dow Jones tracks 30 large, publicly owned companies. The S&P 500, on the other hand, represents a broader view of the U.S. stock market by including 500 large companies across various sectors. These indices are more than just numbers flashing on a screen. They tell a story about the health and direction of the market. Understanding what they represent and how they move can be invaluable for any investor. When these indices go up, it generally means that investors are optimistic about the economy and the future prospects of the companies within that index. Conversely, when they go down, it suggests pessimism and uncertainty. Keeping a close eye on these indices can provide valuable insights into market sentiment. Now, let's talk about a technical indicator that can help you make sense of these market movements, the RSI, or Relative Strength Index. The RSI is a momentum oscillator that measures the magnitude of recent price changes to evaluate overbought or oversold conditions in the price of a stock or other asset. Specifically, we'll focus on the RSI period 2, which is a very short-term indicator. Think of it as a highly sensitive gauge that reacts quickly to price fluctuations. The RSI period 2 oscillates between 0 and 100, with readings above 70 typically considered overbought and readings below 30 considered oversold. Imagine the RSI period 2 as a rubber band. When the price of an asset shoots up rapidly, the RSI stretches towards the overbought territory above 70. Conversely, when the price plummets, the RSI snaps back towards the oversold region below 30. This back-and-forth movement can provide valuable clues about potential reversals in price trends. Here's a straightforward strategy using the RSI period 2 indicator. Buy when the RSI falls below 25 and sell when the RSI crosses above 75. This approach is based on the idea of buying when an asset is potentially oversold and selling when it's potentially overbought. When the RSI dips below 25, it suggests that the asset may be oversold, meaning that the recent selling pressure might be overdone. This could be a good opportunity to buy at a potentially discounted price. Conversely, when the RSI surges above 75, it indicates that the asset might be overbought, suggesting that the recent buying pressure might be unsustainable. This could be a favorable time to sell and lock in profits. Remember, this is just one approach to using the RSI period 2 indicator, and it's essential to use it in conjunction with other tools and your own analysis. Don't rely solely on any single indicator to make trading decisions. One of the biggest advantages of this strategy is its simplicity and the minimal time commitment required. You don't need to spend hours poring over charts or crunching complex numbers. With just 2 to 5 minutes a day, you can check the RSI period 2 readings for your chosen assets and make informed trading decisions. However, it's crucial to have realistic expectations. This is not a get-rich-quick scheme. The stock market is inherently unpredictable, and no strategy can guarantee profits. There will be times when the market moves against you, and you will experience losses. The key is to stay disciplined, manage your risk effectively, and focus on the long term. Don't chase quick profits or let emotions cloud your judgment. Instead, approach trading with a patient and consistent mindset. Section 5. A personal journey, not financial advice. The insights I've shared about the RSI period 2 strategy are based on my own personal experiences and observations in the market. It's important to note that this is not financial advice. I'm simply sharing what has worked for me in the hope that it might be helpful for you. Before making any investment decisions, it's crucial to do your own research. Consider your risk tolerance and consult with a qualified financial advisor. What works for one person may not work for another, and it's essential to find a strategy that aligns with your individual circumstances and goals. Remember, The stock market is a complex and ever-changing environment. There's always more to learn, and continuous learning is crucial for success. Don't be afraid to experiment, adapt your strategies, and seek out new knowledge. Section 6. The importance of risk management. In the world of trading, risk management is not just an afterthought. It's the foundation upon which successful trading strategies are built. Before you even think about entering a trade, you need to have a clear understanding of how much you're willing to risk. One common rule of thumb is to never risk more than 1 to 2% of your trading capital on a single trade. This means that if you have a $10,000 trading account, you shouldn't risk more than $100 to $200 on any given trade. This approach helps to limit your losses and protect your capital from significant drawdowns. Another critical aspect of risk management is diversification. Don't put all your eggs in one basket. Instead, spread your risk by investing in a variety of assets across different sectors and asset classes. This helps to mitigate the impact of any single investment performing poorly. Section 7. Backtesting and historical performance. Before you implement any trading strategy, it's essential to backtest it using historical data. Backtesting involves applying the strategy to past market data to see how it would have performed. This can help you to identify any potential flaws in the strategy and to get a sense of its potential profitability. There are various software programs and online tools available that allow you to backtest trading strategies with ease. These tools let you input your trading rules, such as buying when the RSI period 2 falls below 25 and selling when it crosses above 75, and then run simulations on historical data. Keep in mind that past performance is not necessarily indicative of future results. The market is constantly evolving, and what worked in the past may not work in the future. However, backtesting can still provide valuable insights and help you to refine your strategy. Section 8. Adapting to market volatility. Market volatility is an inherent part of the stock market. Prices can fluctuate significantly in short periods, and it's crucial to be prepared for these swings. The RSI period 2, being a short-term indicator, can be particularly sensitive to market volatility. During periods of high volatility, the RSI period 2 may generate false signals. For example, it might dip below 25, even if the asset is not genuinely oversold, or it might surge above 75, even if the asset is not genuinely overbought. To adapt to market volatility, it's essential to use the RSI period 2 in conjunction with other indicators and your own analysis. Consider using longer-term indicators, such as the RSI period 14, to get a broader perspective on market trends. Section 9. Combining RSI 2 with other indicators. No single indicator is perfect, and the RSI period 2 is no exception. To enhance your trading decisions, it's beneficial to combine the RSI period 2 with other technical indicators. This multi-indicator approach can help to confirm signals and filter out false positives. One popular indicator to combine with the RSI is the Moving Average Convergence Divergence, or MACD. The MACD is a trend-following momentum indicator that shows the relationship between two moving averages of an asset's price. When the RSI period 2 dips below 25 and the MACD is also in a bearish crossover, it strengthens the signal to buy. Conversely, when the RSI period 2 crosses above 75 and the MACD is in a bullish crossover, it reinforces the signal to sell. Section 10. Building a disciplined trading approach. Success in the stock market is not just about finding the right indicators or strategies. It's about developing a disciplined and consistent approach to trading. This involves setting clear goals, managing your risk effectively, and controlling your emotions. Start by defining your trading goals. What do you hope to achieve through trading? Are you looking for short-term profits or long-term growth? Once you have a clear understanding of your goals, you can develop a trading plan that outlines your entry and exit points, risk management rules, and profit targets. Emotions can cloud judgment and lead to impulsive decisions. It's crucial to control your emotions and stick to your trading plan, even when the market is moving against you. Remember, there will be losses along the way, but it's important to stay focused on the long term.